Howdy everybody and welcome back to another stock analysis video. Today I would like to analyze the company Charles Schwab because, well, if you guys guessed it, this company does have earnings coming out on Monday, April 18th, similar to that Bank of America. So let's use this discounted free cash flow calculator and see if this current share price actually matches its fundamentals, and maybe after earnings we might be willing to buy, or maybe we might want to pass on this one. So with that said, let's get started with this analysis. Starting off, we are coming to the dividend summary. Charles Schwab does pay a dividend, a little tiny dividend of 0.97%, which comes out to be 20 cents per share, annual payout of 80 cents. Payout ratio, guys, in regards to the net income is 22.22%. Now, because Charles Schwab actually does have capital expenditures, we can figure out the free cash flow. Therefore, we can figure out the payout ratio in regards to the free cash flow using the calculator. The 5-year growth rate on this dividend is actually, it's not even pretty good. It's very good at 20.61%. And they have increased this dividend non-stop for 6 consecutive years. Ex-dividend date was as of February 10th. Payout date was February 25th. And they pay their dividends quarterly. Now coming over here to the calculator, we got the ticker symbol of SCHW. This is the Charles Schwab Corporation, not the ETF. Market cap of $157 billion. PE, guys, of look at this, 29.29. So based off of the earnings, this is pretty much just telling me that at the current share price of $82.75, this is pretty much really expensive, right? It's fairly expensive. However, now take a look at other metrics, take a look at the shares outstanding, take a look at the cash flow, project it into the future, discount it back to today, and let's figure out what price we should actually be paying for this company today, assuming future assumptions. Annual dividends, as we saw, was 80 cents a share, which comes out to be, guys, $1.5 billion being paid out of dividends every single year. In regards to the average free cash flow, we see that after this dividend is paid, they're still left with a pretty good 5-year average free cash flow of $3.8 billion, which is only 28.38% of the payout ratio in regards to the free cash flow, meaning that they can 100% continue to increase this dividend into the future. Now let's come over here to the fundamentals, starting with, of course, the net income as always. 5 years ago of $2.4 billion to 1 year ago of $5.9 billion. This is an increase of 149%. Very, very good. As we can see right here, 3 years ago, it was going up fairly steady. 2 years ago, because of COVID, it went down to 3.3, and then 1 year ago, boom, it just shot back up to $5.8 billion. Now let's come over here, guys, to the free cash flow, the lifeblood of the company. This is by far the most important metric that we have because this one tells you whether or not the company is able to pay down their debt, pay out dividends, etc, etc, etc. And you can see right here, the cash flow when it comes to Charles Schwab, very, very surprising. I had to double check my numbers. 5 years ago of negative $1.2 billion to 1 year ago of positive $1.2 billion. Now, while this is an increase of 197%, with a 5-year average free cash flow of $5.3 billion, this is looking very, very bad, right? 5 years ago, they were negative, so that's already a major, major red flag. 4 years ago, they shot up to $11.9 billion. 3 years ago, they went down to 8.6. 2 years ago, during COVID, they went down again to 6.2, and then last year, they went all the way down to 1.2. This is very, very concerning. So definitely to do a lot more research here. And in regards to the free cash flow, even though this is a positive metric, the way that I look at this graph is that it is going down and it is technically a negative metric. Now let's take a look at the revenue. 5 years ago of $8.6 billion to 1 year ago of $18.5 billion. Increase of 114.9%. And honestly, I would have figured that this would be a lot higher than just these numbers. I mean, from 8 to 18, yeah, that's good, don't get me wrong. But Charles Schwab is a pretty big corporation. I would have figured that they would be significantly higher when it came to their revenue. Looking at the total assets and total liabilities, let's see if they are able to cover their liabilities / their debts and see how much money would they have left. As you can see, guys, currently, if they were to liquidate all of their assets, they would have $56.3 billion left. Now, what's interesting here is that it has remained steadily at 56 for the past 2 and 1 year, and even today as well. However, if you take a look at the 5, 4, and 3 years, it was roughly at around the $20 billion mark, and then from 3 years ago to 2 years ago, it just shot up entirely. Something happened here, don't necessarily know what. Nonetheless, this is a positive metric. Average assets around $453 billion, average liabilities around $414.6 billion, average assets minus the average liabilities, we get around $38.3 billion. Now looking at the shares outstanding, a metric that a lot of people tend not to understand and just simply don't know that it exists. This tells you whether or not the company, the CEO, the board of directors, etc. is diluting you as the investor. You want this number to be coming down. And unfortunately, well, this isn't the case when it comes to Charles Schwab. 5 years ago, of 1.3 billion shares to today, guys, of almost 1.9 billion shares. On the 5 years, this is an increase of 40.73% of shares outstanding. And from the previous year to the current year, so we're looking at from the 2 years ago to the 1 year ago, it is an increase of a little bit more than 2/3%. And actually, something's very, very interesting. We can see a correlation between the assets and liabilities and the shares outstanding. Pretty much at the 2 year ago mark, it just completely shot up, whereas 3 years ago, it was significantly less. So as we can see from the shares outstanding, this is a pretty bad metric there, diluting you as the investor. And when it comes to coming up with a final share price, we have to take into account these dilutions. And lastly, we got the cash and equivalents, and currently they have almost $63 billion in cash and equivalents with an average cash equivalents of $39.6 billion. Now time to make some assumptions. Low, median, high, using 3 different factors: revenue growth, predicted share buyback, and the required rate of return. Revenue growth, guys, I like to use Seeking Alpha's growth tab, looking at the revenue growth year over year and the revenue growth forward, coming up with a number in between those two. Predicted share buyback, I'm going to using the shares outstanding graph that we just saw. And for the required rate of return, I'm going to keep it the same, 10%, to match the S&P 500 on the best years. So for my low assumption, let's just say a growth of 18%, projected share buyback of -3%. This comes out to be a target share price of $98.88. Now for my median assumption, let's just say a growth of 20%, projected share buyback of -6%, and this comes out to be, guys, a target share price of $102.18. And lastly, for my highest assumption, let's just assume a growth of 22%, predicted share buyback of -9%, this comes out to be $105.52. Now adjusting for debt, the way we do this is we take the cash equivalents and we add the net debt. They have more debt than cash, then obviously this number comes down. If they have more cash than debt, then this number comes up. So you can see, for my lowest assumption, it comes all the way up to $131.17. For my median assumption, it is $133.53. And for my highest assumption, it is $135.97. Now adding a margin of safety of 5, 10, and 15%. Solely because of the fact that you don't want to overpay for something. The more you pay for something today, the less returns you are going to have in the future. Therefore, for adding this margin of safety, for my lowest assumption, we would like to buy between $111.49 to $124.61. For my median assumption, I would like to buy between $113.50 to $126.85. And for my highest assumption, I would like to buy between $115.57 to $129.17. Guys, the current share price is $82.75. So, in all of my assumptions that you see right here, this is essentially saying that this is pretty much overpriced. Now, obviously, if you take a look at my lowest assumption, not adjusting for debt, this is the closest one to the target share price. However, when you take a look at the grand scheme of things, guys, their fundamentals are not as good as I thought. Right, their cash flow is pretty bad in my personal opinion. Their shares outstanding are increasing very, very much. And yeah, I just thought that I would see better numbers here as for like a big major corporation as big as Charles Schwab. So this is kind of underwhelming in my personal opinion. Now, am I telling you guys not to buy this? Well, absolutely not. These are just my assumptions that you see right here, all of them, including the required rate of return. What I always like to tell people in every single video is, guys, I have this calculator available for free. Anybody could have it. I also have one that is used for banks, insurances, and utility. Because unfortunately for those, since they don't have free cash flow, we have to use something else called book value. So I have these two calculators. If you guys want to use them, they are all available for free. All I am asking for in return, guys, is like, subscribe, comment. Thank you so much for the 500 plus subscribers here on YouTube. Absolutely amazing. It actually really does encourage me to make more of these kinds of videos and even come up with new calculators. I'll be working on the REIT calculator, or at least improving it in a couple days, because I mean, you guys seem to be liking it, and pretty much once we finish the REIT calculator, that'll pretty much cover all the stocks. But yeah, it really does help here on YouTube if you guys like, subscribe, and comment. Again, I made all these calculators for you guys. I even made out a video as to how to use and set up my dividend tracker sheet. So if you guys want to see that, make sure to check that out. And all I'm asking for in return, guys, for 30 seconds of your time to, of course, like, subscribe, comment. That's about it. You get everything for free. All I'm asking for is just, again, like, subscribe, comment, tell your friends, and hit that bell. Now looking at the dividends at the current share price, let's just say that we take the average US income at $68,703. We bring it to the monthly, this is $5,725. At the current annual dividends per share of 80 cents, if you were to put in 1 month's income into this company, how much money would you get in dividends at the annual, quarterly, and monthly dividends? Well, $5,725 would buy you around 69.19 shares, which would be an annual dividends of $55.35, quarterly dividends of $13.84, and monthly dividends of $4.61. So as it stands, this isn't that good. Now don't get me wrong, this company does have potential with the 5-year CAGR at like what, 21%. However, fundamentals aren't really that good, and yeah, you're just pretty much not getting a good dividend yield when it comes to buying them at this current rate. All in all, when it comes to Charles Schwab, again, very, very surprising. I was not aware that a company this big would be, well, this underwhelming, right? At this PE of 29.29, and we just saw all of the target share prices. Yeah, this to me seems very overvalued, and me personally, I would not be buying it. Even though this does pay a dividend, there are better companies out there that pay a higher dividend for starters and that have a significantly better fundamentals. That pretty much is it for this video. As I said before, like, subscribe, comment. You guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble. All links in the description below. I also have a Let's Play channel, also link in the description. So if you want to see me play Sonic Unleashed, which I'm currently playing through right now, you guys can follow me there. And with that said, peace out, and of course, be on the lookout for the next stock analysis video.